Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 23 in our series for 2025, and today's date is Friday, July the 18th. First, I'll be talking to Steve Plarre, the CEO of Plarre Foods, who has helped rebuild the family brand to become an award-winning sustainable business. It currently boasts 85 stores across Victoria, apart from a strong focus on profitability and growth, perhaps across Australia, even using AI to build the business. They have a plant-based pie and sausage roll in their range as part of their savoury turnover. It sells under the Pie Society brand at Woolies and Coles. They've even opened up Plarre Foods drive-thrus next to Coles Express stores, perfect for those seeking a meat supplement or faux meat dish. Plarre Foods is a family business with franchisees, a fascinating business story, and I'll be talking to AMP Capital Chief Economist Shane Oliver, who will explain why the RBA kept rates on hold, what impact this will have on markets, and whether we can expect more rate cuts this year. But first, let's talk to Steve Plarre.
Steve, your business has been in operation now for, what, 4 generations of family?
Oh, yeah, it has. Yeah, over 120 years.
Wow. And so you've been through world wars and pandemics and everything like that?
Well, certainly. I now have been through a pandemic, but up until then, they were footnotes of other generation that had run the business. But yes, it has been through a lot of stuff.
And the Great Depression, of course.
And it has, absolutely, yeah.
Yeah. Now, what was interesting was a few years ago, you were in partnership with the Ferguson family.
Correct.
And you bought them out.
We did, yes.
What was the reason for that, and what did that do for the company?
Yeah, sure. So look, I mean, over the history, the Fergusons and the Plarre families had similar histories. We came together in the 1980s, right? And then for the next 30 or so years, that was terrific. But we did find ourselves with, I guess if you run the analogy of having a footy team with 2 coaches, at some stage you might have some different strategies. And for us, they were also life stage strategies. So my brother and I, 4th generation, but I was co-CEOing with 3rd generation, and different risk appetites, different investment plans for the future. So really, it just did get to the point after 30 years where we had quite different visions of what the future needed to hold for the business, and we couldn't come to an agreement on that. So that's the very short version. So in 2012, we bought them out, and part of that was us feeling like, the Plarre family feeling like we really needed to invest in the brand and the future. We had so many loyal customers, and if you go to a Ferguson Plarre now, you'll still see lots of baby boomers and retirees who obviously did a very good job of communicating and marketing to them and selling them something they loved when they were a lot younger. And so spending a lot of time investing in that now to make sure that in another 20 or 30 years, young mums and dads who are shopping with us now, are going to be shopping with us in another 20 or 30 years for the next gen.
So the demographic of your customer base remains the same.
It really does. I mean, we're full range bakery minus bread, I guess. So we've got a really broad spectrum of customers, but you've got about 5 personas that we sort of identify depending on the range and where we're at. So we still have a very, very strong pull with the boomers, but of course they're often introducing their grandkids and their kids to the brand, and that is traditionally how Ferguson Plarre has done very well over the last 100 years.
So how many Plarre outlets are there?
We've got about 85.
Is that around Victoria, around Australia?
Yeah, just in Victoria, actually. Yeah.
And they're franchises, aren't they?
Predominantly. So out of those 85, you'll find that we've nearly always got about 10% of the stores are company-run stores. So that's where we might be, testing products, testing new service models, testing technology, or if we have the opportunity to open a store and we don't have a franchisee for that location, we'll jump in. Or if a franchisee is in distress, we need to make sure we've got some really good bench strength on staff so we can jump in there and help them run their stores.
So it's about 10%, so about 8 stores. 8 of the 8.
Yeah, between 8 and 10, that'll flex. Yeah, absolutely.
Right.
About 75 of those stores will be franchisees, and quite a few of them are multi-site, so they'll have 2 or 3 stores.
So what kind of people come in as franchisees?
Oh, look, a very broad range. We've got some, very broad. I've got some franchisees in their 20s. I've got some franchisees in their 60s, and ethnicity a very representative of the Australian, breakup, which is incredibly diverse. So, we often try and, targeting for this kind of stuff is so important. But when we sit down and we have a look at our best operators, our worst operators, and what have you, there is no age, there is no at a cultural level, there's no connection there. It is that our best performers are people who love people. They love to have conversations. I think if you're in most food businesses, people buy a product, but more than the product, they buy inclusion, they buy a conversation. Is my name remembered? Do they know what my kids were doing on the weekend? We've got an incredible frequency with customers, and lots of cafes would, especially when you bring it down to coffee and what have you. You see the same customers every day or every second day, and so it's those franchisees that can connect with other people. So when we meet them for the first time, the first thing we look for, do you enjoy talking to other people? Can you have a conversation with them while you're making a coffee and while you're serving them a pie or an eclair?
So do you train your franchisees?
Yeah, certainly. Yeah, we have a 6-week training program, which involves both in-store as well as in our head office, where they go through a whole bunch of theory. We've got an online learning platform that can then extend to their staff as they bring new people in.
So that's obviously developed over the years with the technology and everything like that.
It certainly has, yeah. I mean, look, back in 2012, it was very, jump in the store and do as I do and learn on the spot. But, over the last sort of 10 to 15 years, tech's made that far more regimented and explicit and helpful.
Now, tell me, you're only in Victoria. Are you planning to expand at all?
Yeah, look, we are. And it's interesting. People say, I got 85 stores, that's a lot. But really, over 120 years, pretty slow moving. And we've got a great culture in the business. We've got 85 stores, but it's still a family business. You've got my brother. We've got a whole bunch of siblings and cousins and husbands and wives who work in the business either through franchising and in the bakery. And fast growth, when we have done it in the past, can really come with cultural risk. So we've been talking about the interstate growth thing for sort of 10 to 20 years, knowing that at some stage we'll run out of land or viable locations, and we're going to be looking. And we often have people call us and say, hey, look, I've got a footprint in New South Wales. I don't want to keep operating it, or I've got a factory, would you like to launch here and we can make your product? So those conversations are live regularly. And in fact, there's a couple now in both the eastern board states. And it's very much about making sure that connection's right, and also making sure we've got some people who, are down in the Plarre business here in Victoria who can go and sort of seed those states properly. So the intention is yes, but only with the right partners, and that could turn up tomorrow, or it might take another 5 years.
Now, you've launched a meatless savoury range, haven't you?
Well, yes, we did actually, just right at the start of COVID.
So what is that?
Sure. So it's not a Ferguson Plarre product, but it did come from Ferguson Plarre recognising, that the plant-based diets were on the growth trajectory. We've got plenty of customers or potential customers who weren't shopping at Ferguson Plarre that could. We made a plant-based pie and a sausage roll. It was a great product, but we really thought that might take a little while to get to scale and volume for us. We were incredibly pleasantly surprised after 2 months. It was 10% of our entire savoury turnover. And we found all these customers who had grown up with meat, but lots of customers for various reasons, often health and environment, had abandoned meat, but still had great memories of shopping with Ferguson Plarre. And so they were the ones buying our plant-based sausage roll and our pie. And we thought, okay, this is unique. And there was some interest from some supermarkets. There was a gap in the market, not very many great products in that space. So we came up with a brand called Pie Society to differentiate from Ferguson Plarre, make sure there was no brand confusion with the stores. And so we created a couple of products that have done very well. We've just launched into Coles this year. And so we're in Woolies and Coles and a number of independents. So it's nearly 2,500 supermarkets around the country selling our Pie Society. We've got a plant-based savoury packed little party pie, sausage roll, pasty, and some plant-based pies. And yeah, it's a nice hedge.
How did you actually create the plant-based pie? I mean, what was the technology that went into that?
Yeah, sure. It was, look, I have spent lots of my life being vegetarian or close to vegetarian, and seeing some of the meat type products coming out that weren't meat, I thought, oh, look, this will be interesting. I wonder how it will fare in a sausage roll and a pie. And there are some question marks from some people around Beyond Meat and some of the other products out there and how they're made. Well, we use a 1,000-year-old Chinese recipe called seitan, which takes wheat wheat gluten, and you kind of make a dough out of it, and it's very sort of chewy and quite meaty. And we put it through a meat mincer and with a bit of lemon juice and some tomato paste. Essentially, we make a dough. It becomes like a mince. It's incredibly, in some ways, it has less complex ingredients than a standard meat pie. But with some delicious gravy and pastry and what have you, it tastes a lot like a meat pie. And so same thing with the sausage roll. So it's Seitan, which is Seitan.
But you've taken the Seitan recipe and you've added your own Plarre ingredients, if you like.
Absolutely. So it's really, it's quite, lots of people who, ask this question about these types of products were like, oh, how do I even know what's in that? Well, it's as I said, it's very simple. And for those people who are looking for a meat supplement or a faux meat flavory product, then, it's been going very, very well.
So what are your plans for the next 5 years?
At the moment, it is continuing growth with the Victorian expansion. There's still, I think there's 100 to 120 potential locations around Victoria, depending on where they are. But that's certainly been assisted by a trial that we started 2 or 3 years ago, where we opened a drive-through location, and there's lots of drive-through concepts going on, but that has been a wonderful success for us. It's a great test. It's a store that is both a walk-in Ferguson Plarre, but it's situated next to a Coles Express, and it's out of the 85 stores operating as one of our second best locations. So we're on the lookout for some more of those. So that'll expand our footprint in Vic, and similarly we'll continue some of the conversations I mentioned around interstate. And then technology, really, I mean, everyone talks about it, right? But we're in a proper AI learning process with some demand planning around looking at, how do we know days and weeks ahead of time where we think certain volumes are going to come from. We've got a pretty good feel. Bakery's and like lots of foods, very temperature dependent. But there's a lot of data out there, and we're about 2 months into a data learning model around how we can better leverage that and also simplify our franchise model, make it easy for franchisees, give them a suggested order on a daily or a weekly basis. So right now, they might check their stock and put their finger in the air and, what am I going to sell tomorrow? But providing some technology to help that become much simpler and allow them to focus on the stuff we love them for, which is smiles, service, having fun in the store.
Right, and all helped along with the help of AI.
Certainly. Well, we're in learning mode. I've got about 90% accuracy running on some products and probably about 20% on others. But it's certainly something we want to understand as we go into it. I mean, there's lots of other facets of AI use in there, but internally with data and manufacturing, we're looking to leverage that. The whole idea is to continue to make our model simpler for franchisees. Allow them to focus on making great coffee, great service, all that personality stuff. That should be pretty foreseeable.
Well, Steve, it's been great talking to you finally, and wishing you all the best.
Good on you, Leon. Thanks so much.
And now let's talk to AMP Capital Chief Economist, Shane Oliver.
Well, Shane, the RBA surprised markets by keeping rates on hold. Everyone was expecting a rate cut. The markets were certainly expecting a rate cut. What's your view about that?
I must admit, it was surprising. I thought the money markets were probably a little bit too confident. I think they had at one stage there 100% chance, and it kept fluctuating, 90% chance, 85% chance. I always thought there was some chance, maybe 20%, that they would leave rates on hold because unemployment was still low. They might further wait to the quarterly CPI. And of course, some of the concerns about tariffs had abated a little bit. But by the same token, I thought the evidence supporting a cut was overwhelming, and that's why I thought they should have cut, and why my base case view, 80% chance, was that they would cut. So I must admit, I was surprised. I'm not entirely sure they've done the right thing there, but I can understand the desire to wait a little bit longer. But obviously, we'll have to wait till the August meeting to see what happens there.
Well, they're obviously waiting for the quarterly CPI figures, which come out at the end of July.
That's right. And that, I think, is a bit disappointing that, in the past, we didn't always wait for the quarterly CPI, but now we seem wedded to that. The ABS did introduce a monthly CPI, which I still can't understand the value of. If the RBA is still waiting for the quarterly all the time, you sort of wonder whether the ABS's money on surveys could be better allocated than the monthly CPI if it has little value. That said, I thought the monthly CPI did have some value, and the trend there is still down. Yes, there's uncertainties about its reliability, but it does have a broad trend. It does give a broad guide to the overall quarterly CPI. And so in that sense, I was a bit surprised that they dismissed it. I think one could also be a little bit confused about what the RBA's, what economists call reaction function is. If you go back to the April meeting, the RBA was quite dovish, seemed to be far less concerned about inflation, now seem to be more concerned about the growth outlook, whereas that seems to have been tipped on its head to some degree in the last meeting. So that, I think, confused people a little bit. And there's also the, what worried me a little bit was the line that the RBA can't talk to journalists or the market. It's now the board that has to do that. And I'm not quite sure how that happens. So you could argue that there's potentially less certainty about what the Reserve Bank will do. And if the Reserve thinks that maybe the market's got it wrong, then it may not be in a position to correct that until the next meeting, which could lead to confusion. So, but bottom line is, anyway, putting all those issues aside, which you might call quibbles with the decision, it does seem that the August meeting is now going to be the one to watch. I think it's live for a meeting. Obviously, in 3 or 4 weeks' time, we get the June quarterly CPI, so that's going to be key. And then we'll get revised forecasts going into that August meeting from the RBA. I think ultimately that'll tip us over into another cut, but for now we continue to wait.
Certainly the money market is expecting cut to 3.1% by the end of the year.
That's right. The money market did wind back their expectations a little bit. It was almost as if almost 4 cuts were priced in out to middle of next year, with 3 priced in by year end, or more than 3 by year end. Obviously, the money market got it wrong, like I did and many other economists. I think 32 economists surveyed by Bloomberg, 4 or 5 were seeing rates on hold. So there were some that got it right. But the money market has simply pushed out their expectations for the RBA cut. So they are still seeing cuts out there. I think they've got something like about a 90% chance of a August cut priced into the money market.
Indeed. And the question is, what happens after that? Can we expect more cuts?
I reckon there probably will be. We're expecting a cut in August, another cut in November, another cut in February, then maybe another cut in May next year, ultimately taking the official cash rate down to 2.85%. I mean, the Reserve Bank waxes and wanes on this. When it suits them, they refer to their estimates of the neutral rate. When it's a bit more hazy, they sort of leave it out. But they did publish some estimates for the neutral rate, the rate of interest, which is seen as being neutral in terms of the impact on the economy, in terms of causing it to accelerate or decelerate. And the midpoint of that estimate was 2.8%. So that suggests that neutral monetary policy is around 2.8%, give or take a little bit. We're currently 3.85%. That suggests, there's still more rate cuts to come, that monetary policy is still relatively restrictive, still relatively tight. And I think that's probably a key part of why we think there'll be more cuts. On top of that, you could argue that we've so far only reversed 2 of the 13 hikes. I don't expect all of those hikes to be reversed. In dollar terms, if you're someone with a $660,000 mortgage, which I think is the average for new mortgages these days, you would have seen almost a $17,000 per annum increase in your interest payments. You're now only saving about $2,500 of that. So we only reversed a very small fraction of the hikes that occurred, which also tells me that there's still pressure on households. And that, I think, is partly why banks are telling us that only 1 in 10 households are reducing their payments with lower interest rates. The bulk are maintaining their payments and continuing to pay down their mortgages at a faster rate, given the interest savings. So I think there's still pressure on households, and ultimately that means less demand out there than would otherwise be the case, which of course means pressure on business investment, downwards pressure on business investment, and therefore the recovery in the economy will be somewhat less than the Reserve Bank's allowing for, ultimately, which I think will drive the Reserve Bank to continue cutting interest rates.
What was the impact of markets with the RBA's decision?
Well, the Aussie share market initially came off a little bit. Prior to the meeting, I think it was down just less than 0.1%. Immediately after the meeting, when I had a look at 3 p.m, it was down 0.2%, and then it closed the day roughly flat. So not a big impact. Maybe the share market is thinking, oh, well, we can wait a little bit longer. The economy's not crashing. So, what's 5 weeks to the next meeting for rate cuts? And we're still going to get those cuts. The Aussie dollar actually had a bit of a bounce. It was around 65 before the meeting and then pushed up to around, I think currently around 65.3 or 4 US cents. So a bit of a bounce back there, but in the same range it's been in for some time now. So I don't think there was a major impact on markets from this, mainly because markets are still expecting those cuts to occur, just a bit delayed.
The interesting thing was that Michelle Bullock was saying that the global economy is still in a worse state than prior to Trump's Liberation Day. And she's saying trade barriers and tariffs are going to be much, much higher, and world trade's going to be impacted.
That's right. Her comments around that were a little bit confusing. She was saying, share markets have recovered. Worst case scenarios have been sort of diminished in probability. But I never thought the worst case scenario was going to happen in the first place. It was going to be a drag on world growth, not a collapse. And then, as you say, she is still saying that there is going to be a drag there. And I think if, Donald Trump's been announcing more tariffs in the last couple of days, those reciprocal tariffs on 14 countries, Japan, Korea, Myanmar, Malaysia, a whole bunch of them, are now going to start on August the 1st. By reciprocal, I mean the tariffs announced on August the 2nd that were then delayed for 90 days. He's basically written love letters, if you call it that, or breakup letters to various countries saying those tariffs are going to start. Most of them pretty much in line with what was announced on August the 2nd. So it looks like those tariffs are still coming. He's also talking about a 50% tariff on copper, 200% tariff on pharmaceuticals and so on. When you're through, you could end up with an average tariff going into the US of around 20%, once you allow for the 40% currently on China. And of course, the situation with China is yet to be resolved. There is another deadline there it's in mid-August. And we've got 50% on steel and aluminium, obviously still 10% on Australia, 25% on autos. When you average all that out and we get to August 1 and those tariffs go up again, then you're potentially looking up around 20, 21% for the average tariff going into the US. Now, if someone told you that the US tariff rate on average was going to be 20% a year ago, you'd say, oh, surely not, it won't be that high. Trump will surely back down, and then he may still back down, but whatever it is, it's still a high number. We started the year at 3%, now we're talking about 20. It's hard to see that not having an economic impact, particularly on the US and also globally. I don't think it's enough to cause recession, but it will be a bit of a drag, and that could cause volatility in share markets once investors realise that this is serious. It's not the very high numbers that applied straight after Liberation Day when China went to 145%. By the same token, it's still pretty high levels, and that is going to be a bit of a drag, and therefore I think it's something the Reserve Bank can't ignore, and is another reason I think ultimately we will see lower rates.
With the tariffs, say the 200% tariffs on Australian pharmaceutical companies, look, the US only accounts for a small fraction of our trade, which is what the RBA was basically saying yesterday. It's only a tiny proportion. We're not that interlinked with the US. So, technically, Australian pharmaceutical companies can sell their goods elsewhere.
Yeah, I suppose that's true. You hope so. Who knows? Like Governor Bullock is right. Only less than 5% of our goods exports go to the US. 35% go to China and Japan and Korea. They're all the big ones. So yeah, it's not going to have a huge impact on us. For those producers of things that do go to the US, yes, there is an impact. They've got to find other markets. As we saw with the Chinese embargo on our products, on 8 products back in 2020, Australia can usually find other markets, but it can take time to do that, particularly if it's a particular type of product. If it's a thing like beef or maybe aluminium, maybe you can just find somewhere else to send it because it's sort of generic in some, well, not totally, I'm sure our beef producers would argue with that, but you can normally switch it somewhere else. I think the technical word is it's fungible. It can go somewhere else. Pharmaceuticals might be a bit more complicated to the extent we might feed into US production chains, and that might take a little bit longer to find other markets. And in pharmaceuticals, last year we exported over $2 billion to the US, which is more than the $800 million we exported in terms of steel and aluminium. So it's a more significant sector to be affected. And 200% is prohibitive. If you basically a 50% tariff, then you make an argument maybe you're still competitive. But when it's 200%, there's virtually zero chance of that. So yes, I don't think there'll be a major impact on the economy from these tariffs. It's only the indirect effect on other countries like Japan, Korea, China, and so on that then has a blowback effect on us. But still, I reckon if you're a pharmaceutical producer and most of your products go to the US, you'd still be a bit nervous about this. And you'd be wondering whether you should set up production in the US. Trump says, well, he'll give them a year or more to move production to the US, but that comes with all sorts of risks. You've got to make a judgment that the tariffs will remain. Will there be a change of government which will reverse the tariffs? So it leads to a whole bunch of uncertainty as to whether it's viable to set up in the US to actually do that. So not good news for our pharmaceutical companies, but for the economy overall, I don't see a major downside from it.
Yes, and certainly, if 200% increase on pharmaceutical goods into the US, in the end, the consumers will be paying more for that.
Well, that's right, and that's what our Prime Minister keeps saying. It's an act of economic self-harm. They're shooting themselves in the foot. And our Productivity Commission tells us that the best response to this sounds counterintuitive, is to cut all tariffs coming into Australia. We still have a whole bunch of tariffs there. I know the Treasurer sensibly got rid of 400 or 500 nuisance tariffs a couple of years back. There's still lots of other funny tariffs out there which we could get rid of and should get rid of. And the reason it harms consumers is because the price goes up one way or another. Either the importer pays the tariff, and therefore they pass that on to the consumer. Alternatively, domestic producers might say, well, we're going to make these things in America now, but that will be at higher cost because wages in the US are so much higher. So therefore, they will see higher prices, whether it's for the imported product or whether it's a domestically made product.
Dude. Well, yeah. Shane, it's been great talking to you. Thank you very much for your time.
Thanks, Leon. Have a good one.
So what's happening in the news? Well, US inflation accelerated in June as President Trump's tariffs started to leave a bigger imprint on the economy. The Consumer Price Index rose 2.7% from a year earlier, the swiftest pace since February. Data released by the Bureau of Labour Statistics showed on Tuesday. This is slightly higher than expected and up from an annual pace of 2.4% in May. Core inflation, which strips out volatile food and energy prices and is seen as a reliable gauge for underlying price pressure, also shifted higher. Those prices were 2.9% from the same time last year. Over the course of the month, prices rose 0.3%, a notable pickup from a 0.1% increase in May. Core prices rose 0.2%. The June data still reflects only the initial impact of Mr. Trump's global trade war. This is just the beginning. Up to this point, inflation has been more muted than feared when Mr. Trump returned to the White House. That had emboldened the president and his top advisors to dismiss the latest set of warnings from economists about the damage steep tariffs could have on consumers and businesses across the country. Officials have been wedded to a wait-and-see approach, opting to keep borrowing costs steady until they have a clearer sense of how Mr. Trump's policies, which beyond tariffs include a crackdown on immigration, sweeping tax and spending cuts, and a broad deregulatory push, will affect the economy. The US inflation data tells another story. And US President Donald Trump has announced that the US will impose 100% secondary tariffs targeting Russia's remaining trade partners if a peace deal with Ukraine is not reached within 50 days. This would see any country that trades with Russia face the tax if they want to sell their products to the US. For example, if India keeps buying oil from Russia, US companies that purchase Indian goods would have to pay a 100% import tax or tariff when the products reach American shores. This would make the goods so expensive that US businesses would likely choose to buy them cheaper from elsewhere, resulting in lost revenue for India. The intention is also to hobble Russia's economy. Theoretically, if Moscow was unable to generate money by selling oil to other nations, it would also have less money to finance its war in Ukraine. Given that oil and gas account for almost a third of Moscow's state revenue and more than 60% of its exports, 100% tariffs could make something of a dent in Russia's finances. This coincides with Trump announcing that the US will send top-of-the-line weapons to Ukraine via NATO countries. "We want to make sure Ukraine can do what it wants to do," Trump said following a meeting with NATO chief Mark Rutte in Washington. Rutte confirmed the US had decided to massively supply Ukraine with what is necessary through NATO, and that the Europeans would foot the bill. European countries will send Kiev their own Patriot air defence systems, which Ukraine relies on to repel Russia's deadly airstrikes, and replacements will then be issued by the US, Trump said. Neither Rutte nor Trump elaborated on the weaponry that will be sent to Kiev, but Rutte said the deal included missiles and ammunition. And the Albanese government has been advised the budget cannot be fixed without raising taxes and cutting spending, and that its housing target is unachievable. The advice, written by the Independent Treasury and offered after Labor's re-election, warns the government's signature pledge to build 1.2 million homes over 5 years to address a housing crisis will not be met. The Treasury advice does not elaborate on which taxes could be raised, but suggests the Treasury canvass indirect taxes like the GST, wine equalisation tax and luxury car tax and superannuation tax as possible targets. It appeared to favour lower taxes on companies and personal income. Treasury advised that improvements to the budget will need to come from economic growth, additional revenue and spending reductions, and that tax should be raised as part of broader tax reform. The department also advised Mr Chalmers and Housing Minister Claire O'Neill that the 1.2 million homes target would not be met, and floated changing it, advising the government to build on its agenda by crafting a coherent and well-prioritised housing agenda. There's been substantial public commentary about the viability of the target, with housing completion so far well off track, and the ministers have described the target as ambitious but maintain it can be met. Mr Chalmers has since declared an appetite for tax reforms reaching beyond Labor's election platform, and will hold a roundtable in August with tax on the agenda, saying proposals should improve the budget bottom line, or at least be budget neutral. And for its part, the Commonwealth Bank of Australia has urged Treasurer Jim Chalmers to consider major tax reform to revive productivity, including slashing income taxes, lifting the GST, capping superannuation tax concessions, and introducing wealth taxes. In a frank submission to the Productivities Commission review ahead of Chalmers' Economic Reform Roundtable next month, the largest lender also said lowering company taxes should not be a priority. CBA's priorities, as outlined in its submission, include capping tax concessions on high balance superannuation accounts, which would raise tens of billions of dollars in additional tax revenues in the coming years. We would support a superannuation cap set at a level that encourages aspiration and set well above the level where there is dependence on the state for support in retirement, its submission states. In its submission, CBA said the Henry Tax Review from 2010 was a sensible starting point to launch a national conversation about tax reform. Its author, respected public servant Ken Henry, was prohibited from considering changes to the GST, but put forward 138 other recommendations. The most significant was to introduce a resources super profit tax. This was made law by the Gillard Labor government in 2012, but abolished by the Abbott coalition in 2014 after a fierce backlash from industry. CBA said the federal budget's current reliance on personal income taxes was not sustainable in the long term to fund the level of public services people want. Personal income tax hit a record $349 billion, or 52% of the federal tax take in 2023-24, the highest share since the 2000 financial year, shortly before the Howard government introduced a 10% GST, in part to take tax pressure off wage earners. Australia needs to find a way to lower its dependence on income taxes, CBA said. We believe it should be possible to achieve a revenue neutral but more sustainable tax mix through a package of measures. Australia's prosperity has been built on waves of reform to align our tax system to the economic demands and opportunities of the time. We now need to catalyse the next wave of tax reform debate, which should include the appropriate levels and role for consumption and wealth taxes, for distributional fairness, and for incentivising productive activity in the economy. After boasting about Labor's back-to-back surpluses and improvements to the budget during the election, Chalmers delivered a sombre assessment last month that the budget was unsustainable and in need of serious repair. No sensible progress can be made on productivity, resilience or budget sustainability without proper consideration of more tax reform. I don't just accept that. I welcome that, he said. The Treasurer initially indicated that although he was reluctant to introduce changes to the GST, he did not want to artificially limit contributions to the Economic Reform Roundtable, leaving changes up for debate. But speaking at a summit last month, Prime Minister Anthony Albanese tried to slam the door shut on GST changes. Consumption taxes, by definition, are regressive in their nature, so that's something that doesn't fit with the agenda, he said. On Monday, Chalmers fell into line when asked whether he would support GST reform if the states brought a joint proposal to the federal government. I think both the Prime Minister and I have made it pretty clear when it comes to the GST. We've had a view about that historically, and that view hasn't changed, he said. And Anthony Albanese has rebuffed US pressure to commit to preventing Taiwan from attack, overshadowing a 6-day visit to China aimed at bolstering economic ties with Australia's biggest trading partner. Albanese arrived in Shanghai for his second official visit to China and met Chinese President Xi Jinping and Premier Li Qiang on Tuesday. He spent his first day spruiking a new agreement that the government hopes will kickstart stalled tourism to Australia. The Trump administration's Undersecretary for Policy, Elbridge Colby, is already leading a review of the AUKUS agreement between Australia, the US and the United Kingdom, and increasingly pushing for firmer commitments about how nuclear submarines will be used. Colby has asked Australia and Japan about what they would contribute to defend Taiwan from China. But the Prime Minister said private discussions with the Trump administration were already in progress about how the AUKUS nuclear defence pact would work, insisting the increase in military spending and the acquisition of submarines were intended to prevent war, not cause it. There is no fixed model for a stabilised relationship. Our job is to make sure that we manage our relationship so that we can contribute to regional and global global peace and prosperity, he said. Dialogue advances cooperation and addressing our differences without allowing them to define us. Press about Taiwan in a media conference in Shanghai, Albanese said, "We support the status quo when it comes to Taiwan. We don't support any unilateral action there. What's important when it comes to international relations is that you have a stable, orderly, coherent position going forward. We want peace and security in our region. Our alliance with the US is a very important one for Australia. So we'll continue to engage constructively in a coherent, stable, orderly way," he said. "Our aim of investing in our military capability and as well as investing in our relationships is about advancing peace and security in our region. That's our objective, and that's why we invest in our military. The Australian government's official policy is not to recognise Taiwan as a sovereign state, although, like many other countries, it has informal and unofficial ties with Taipei on economic and development matters. The US has a similar position and has not made any formal commitments to defending Taiwan in the event of conflict with China. At the same time, Anthony Albanese is refusing to buckle to Chinese pressure to back down on his election vow to force the Chinese owners of Darwin Port to sell the key asset, despite a fresh warning Beijing could retaliate by limiting Australia's lucrative $105 billion iron ore trade. However, while Australian analysts believe the threat to iron ore was a hollow one, China may see retribution elsewhere. Lowy Institute senior fellow Richard McGregor said Beijing would undoubtedly punish Australia if there was a forced sale. The issue of ports is not just about Australia. It goes much further than that, he said. Chinese state companies have built an extensive network of ports around the world, more than 100 ports in about 50 countries. They do not want to see a precedent set in Australia, which would be followed by governments elsewhere in the world. Australia will have to be seen to pay a price. And Prime Minister Anthony Albanese has raised Australian concerns over Chinese steel dumping and has urged industry leaders from both nations to work together to develop low-carbon steel production methods. At a roundtable of Australian iron ore producers and Chinese steelmakers in Shanghai on Monday, Mr Albanese called on China to address an oversupply of steel in the global market. Excess Chinese steel production, the result of prolonged economic stimulus and weak domestic demand, has flooded the international market in recent years, squeezing producers in places such as the US and Europe and precipitating allegations of dumping. Australia imposed anti-dumping duties on steel imports from China, but the World Trade Organization found they were improperly applied. Mr Albanese knows Australian miners and government revenue streams are vulnerable to a downturn in the iron ore price. As both countries cooperate to advance decarbonisation, we also need to work together to address global excess steel capacity, he told the roundtable on Monday morning. It is in both countries' interests to ensure a sustainable and market-driven global steel sector. It's hard to overstate the Australian economy's dependence on the Chinese iron ore trade. China is by far Australia's largest export destination, and iron ore is by far the largest component. And Australia's largest banks and retailers have agreed to tip in $25 million to keep Armaguard, the monopoly cash transportation business owned by billionaire Lindsay Fox, operating until the end of the year. The companies, Commonwealth Bank, Westpac, National Australia Bank, ANZ, Coles, Woolworths, Bunnings and Australia Post, last year paid Armaguard some $50 million to keep operating after the Fox family suggested it was not profitable and could shut. Cash payments are expected to fall to 4% of transactions this decade. Still, while fewer people are using cash, Armaguard is crucial to its circulation around the economy. When concerns about its possible demise were at their highest, some supermarkets began hoarding cash to make sure that they did not run out of reserves over the Easter holidays. Multiple people involved in the negotiations confirmed that a deal had been agreed over the weekend, which extends Armaguard's lifeline until the end of December. In many European countries, cash has been designated an essential service and is regulated by central banks as its use plummets. And that's it for this week. And next week I'll be talking to David J. Greer, an entrepreneurial coach specialising in creating high-performing and high-growth mid-market businesses. He helps entrepreneurs challenged with alcoholism or addiction. And I'll be talking to RMIT economist Jonathan Boymel about trends in the Australian property market. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you can find me on Facebook, Twitter, or X as it's now known, Instagram, LinkedIn, and YouTube. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also in my spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles or advertorial, email me. Looking forward to the next episode of Talking Business.